Why hasn't the US housing market crashed yet? And could we be seeing a repeat of what happened right before 2008? Because we're in a very interesting time if you're a home buyer or a real estate investor right now, where the housing market is massively overvalued, home buyer demand has collapsed, but prices have remained resilient. Where you can see data from the National Association of Realtors is saying that prices are only down by 1% year over year in June 2023. Similar decline to what we saw in 2006, 2007 at the start of the last downturn. And what concerns me is that lots of people in today's housing market are thinking that there is no crash or that it's not going to get worse simply because it hasn't happened yet. And I would caution you guys against thinking that, because right now the housing market is massively overvalued, with home prices about 31% overvalued compared to the level of incomes in America and 26% overvalued compared to the level of rents. And these sky high levels of overvaluation are even worse than they were in the lead up to the last housing bubble, which suggests that massive downside still remains for home prices in the US housing market. However, there's an obstacle, a barrier that's keeping these price declines from occurring, and that barrier is low inventory. There simply aren't many homes for sale. With data from the National Association of Realtors showing that single family house inventory is clocking in only around 950,000 right now, that's about 50% below the long-term historical average, and you can tell this inventory has been on a structural decline for the last 8 or so years. This low inventory is what's causing prices in America's housing market to remain resilient and even to have gone up this past spring. However, what's important for you as a home buyer to understand is that this is not a stable situation. Inventory is not low because there's strong buyer demand. Rather, inventory is low because sellers are refusing to list their homes for sale onto the US housing market. With data from Redfin showing that new listings for sale are down by about 25% from their long-run historical norm. But I'm going to tell you why I think inventory is going to increase on the US housing market into the future and push prices down. And that's because there's lots of, let's call them, risky mortgages out there on the US housing market right now, everyone. This is something you really have to understand about why it's a potential risky time to buy right now, is because there's lots of homeowners in America right now that can barely afford their mortgage and property tax payments. We have lots of homeowners who are what is called house poor, who are just barely getting by on paying their mortgage. And because the unemployment rate is low and because we haven't seen the recession worsen, they're holding on. But these people are at high risk for selling into the future if the economic downturn gets worse. And one way to understand this, folks, is to look at a metric called the debt to income ratio for home buyers in America. This is a data point tracked by the Federal Housing and Finance Administration, the group that runs Fannie Mae, and they are reporting that the debt to income ratio is now approaching close to 40% on the US housing market. In the third quarter of 2022, it was 38.8%, and I'm projecting that today, in the first quarter of 2023, it's 40%. And what this means is that the average home buyer in America's housing market with a mortgage is spending close to 40% of their gross income on their interest in mortgage costs. Now, why that's very concerning is because that's a very high level of mortgage interest debt. It shows that people are very stretched, and in fact, it's a higher level of interest burden than people had in the run-up to the last bubble. When the debt to income ratios in 04 and 2005, they registered around 37% and peaked at 39% in 2007. So I want you folks to think about this. The mid-2000s was known for all the bad mortgages that people took out that people couldn't afford, yet the debt to income ratios back then are comparable to what home buyers are buying at today, which suggests that we are going to see mortgage defaults and foreclosures in this housing cycle. There's lots of people who like to think that we're not going to see those. They say that we don't have bad loans anymore. They say we don't have subprime loans, and thus there won't be foreclosures. But how could that be the case if the debt to income ratios today are the same as they were in the mid-2000s, while the down payment levels today, they're actually lower than they were in the mid-2000s? People put more money down, around 22%, on their home purchases in 2006, according to the Federal Housing and Finance Administration, than they are today, which means that we will see a wave of inventory and forced selling on the US housing market at some point in the future. I can't tell you exactly when that's going to be, which I know is frustrating for a lot of you home buyers out there who've been waiting 1, 2, maybe 3 years to buy a house. Some of you are at your wit's end and don't want to wait anymore, which is understandable. However, it's my job to inform you guys that it's still a very risky proposition to buy a house today with how overvalued the housing market is and how many, let's just say, stretched out mortgage holders and mortgage borrowers there are. And these factors are now intersecting with a massive collapse drops in home buyer demand. The mortgage purchase applications, the home sales, they're close to the lowest level in 2 decades. With CNBC reporting that June home sales just dropped to their lowest pace in 14 years as short supply chokes the market. June home sales were 19% lower than they were last year, the slowest pace since June 2009. And so very important that you guys understand this point, whether you're a buyer or an investor, is that the demand in the market is still at rock bottom levels. Home buyers, they are out on the housing market. They don't want to buy. They know prices are too high, especially with mortgage rates now hovering around 7%. The affordability metrics just make it not feasible for the vast majority of people to purchase a home. And just how bad is this situation? Well, according to the National Association of Realtors, seasonally adjusted home sales were 4.16 million in June. Now you can see that's way down from the home sales and buyer demand we had during the pandemic. And you can see this yellow dotted line. Yes, it's legitimately at the lowest level of home buyer demand that we have seen since the start of the 2007-2008 crash. But there's a big, let's just call it, disagreement in the real estate industry about why home buyer demand is so low right now. People who are bullish on the housing market, people who work for the National Association of Realtors and Redfin, they claim that buyer demand is low because inventory is low. For instance, Lawrence Yun, the chief economist for Realtors, said that there are simply not enough homes for sale. The market can easily absorb a doubling of inventory, is what he says. So he says if listings and inventory doubles, there'll be the buyers there to absorb it. But I disagree with Lawrence Yun. I think the reason buyer demand is so low is because the affordability metrics are so poor on the US housing market. Think back to those graphs I showed you in the beginning of this video. The housing market's 30% overvalued compared to incomes and rents. And when you factor in 7% mortgage rates, well, most home buyers just have no hope of buying a house, especially in a state like Florida, where the house payment as a percentage of median income is now 45%. In Florida, the median household makes 66 grand. They would have to spend $30,000 a year on their mortgage, interest, property taxes, insurance in today's market. Or let's zoom on over to California, where the typical house payment is 62% of the median household income. I mean, very clearly, especially in these states in red, the home buyer affordability is so bad that even when inventory increases, there won't be the buyers there to backfill the demand because they just can't afford it. And just to see, let's just take a look at Montana. Today's home buyers in Montana need to spend 52% of their income on a house to afford it. Previously, historically, that was 28%. The last bubble was only 32%. So we're at an unprecedented level with how bad affordability is. And until that affordability conundrum gets solved through the way of both lower home prices and lower mortgage rates, we will not see a meaningful recovery in buyer demand, which is a big problem for a lot of people in the housing market, particularly realtors. I know I have a lot of realtors that watch this channel, and I know that some of you are struggling right now. I mean, these very low levels of home sales combined with the beginning of price declines have really cut into how much money realtors make, with the number of single family home sales per realtor only registering 2.3 per year right now. That's basically the lowest level of sales activity per realtor of all time. And because of this reduced sales activity, we are now seeing realtors quit. I first reported on this about a month or two ago, and since then, we've continued to see realtors drop out of the market, with realtor growth now falling to minus 1.1% year over year. So we're now about 3 or 4 months into declining levels of realtors year over year. You could see that it was around the same time in late 07 that we started to see this decline in the last crash, as well as in the early 1990s during that last housing downturn is when the realtors started to quit. And to me, this is a big leading indicator that's telling you where the housing market is heading, and it underscores the fact that housing downturns happen slowly. And if you're a home buyer and investor wanting to understand the housing market, you have to understand this point. The housing market does not act like the stock market. You will not see prices drop 30 or 40% in a year or 6 months. It will take significant amounts of time for both home sellers and realtors and a lot of it legacy investors to accept the fact that the market has entered a downturn. And historically, on average, a housing downturn takes 5 years from start to finish. Whether you look at the downturn from 2007 to 2012 or the one that occurred in the early 1990s in different regional markets in America. And that fact and reality, I think, is uncomfortable for a lot of people because it suggests that we're not going to see immediate relief. We're not going to see all of a sudden tomorrow for you as a home buyer, it's just not going to get like way better to buy a house. It's going to be an incremental process, which you can understand if you look at maybe this listing on Zillow. Now, this listing is in Nashville, where there's lots of inventory on the market right now. It's on the market today for $975,000. Still a high price, but you can see originally it was listed in March for $1.4 million. This was actually a flip. They've just been incrementally cutting the price more and more. And the price is still high, but the point is, if a seller has an idea of what the value of their house is, whether it's 1.4 million from the start or whether it's 900,000 from the start, they're not just in a month or two going to cut it by 30 or 40%. It's going to be an incremental process. That house might have to be on the market for over a year before the seller's finally going to wake up step by step to the price that it should actually be to sell. And we have quite a few housing markets in America right now that are going through these fairly large price cuts and where prices are going down. The way to track these housing markets to understand where prices are going down is to go to Reventure app and go to a metric called price cut share. This tracks the percentage of sellers cutting the price and which states have the most price cuts. Well, you can see in red, Texas has a lot of price cuts. Colorado, Utah, Idaho, they're towards the top. Interestingly, Indiana is number one in terms of the share of sellers cutting the price. But let's get even more granular and look at all the different metro areas in terms of price cut percentage. If we just filter to metros above 250,000 in population, we can see the ones with the biggest price cuts are Austin, where 46% of sellers reduced the price. Most recent month, we also have Colorado Springs, Fort Wayne, Indiana, Evansville, Indiana, Huntsville, Alabama. This is an interesting one. Huntsville seems to be on the decline now. Waco, Texas, Ogden, Utah, Mobile, Alabama, South Bend, and Denver. But it's not just price cuts, everyone, that's going to tell you the market's going to go down. It's also price cuts in combination with higher inventory and higher days on the market. Those three things really will tell you the direction of your housing market into the future, and they're all available on Reventure app. And one thing I like to do is actually filter and find the cities that have the most price cuts, the most inventory, and the highest days on the market. Which we can do here through the filters tab. Let's filter price cuts above 20%. Let's filter inventory growth above 20%. And let's add days on the market growth also above 20%. What do you notice? Okay, what's left here? Well, these would be the housing markets that are most likely to see price declines over the next several months. They're almost all predominantly in Texas, Florida, and certain parts of the Southeast. Now, we can also conduct the reverse analysis to see which markets are least likely to see price declines over the next 6 months. They would be the ones with the fewest price cuts, the lowest inventory growth, and the lowest days on the market. What do we got now? Well, now it's the reverse. We've kicked out all of these markets in the Southeast, and now we're focusing mainly here on the Northeast. We have some Northeast markets where they're still very, very tight. Prices will still likely go up or stay flat for the rest of the year. Also in the Midwest and Chicago. Also, we're seeing some interesting things happen here in California, in markets like Sacramento, Stockton, San Jose, and Visalia, where these markets have turned a lot in the last 6 months, and they're starting to favor sellers more than buyers. And that's due to, again, the decline in inventory. There's been a big drop in inventory in California over the last year. In a market like San Diego in particular, inventory is down 35% year over year. And that's now causing the California downturn, which was, the hardest hit market, to stabilize. And I know this has been a frustrating thing for a lot of you home buyers in California. You're wondering, well, with prices and mortgage rates still so high, how is it that I'm not seeing better deals out there? And it's because of a lack of new listings. And unfortunately, in California and other cities around America, it's going to take some of these sellers being forced to sell through mortgage defaults and liquidity needs and things like that to return new listings to the market and push inventory up and prices down. But some people are now convinced that that's not going to happen. Some people keep saying things like, we're never going to see inventory increase because all these home buyers have 3% mortgages that they've locked in and will never sell. You can let me know in the comments if you've heard someone say that or you think that yourself. And I actually polled you guys here on YouTube and I asked you the question, what percentage of America's 97 million houses have a mortgage rate less than 3%? Now, 29% of you said 15% of houses have a mortgage rate less than 3%. 29% of you said 30%, 18% said 50%, and 24% said 65%. So a quarter of you think that 2/3 of houses in America have a mortgage rate less than 3%. And folks, yeah, if 2/3 of homeowners in America have a mortgage rate less than 3%, well, then we will never see inventory increase. I would agree with that. But what's the actual number? How many homeowners in America have a mortgage rate less than 3%? Well, data from the Federal Housing and Finance Administration shows that 23% of mortgage holders in 2023 have a sub 3% rate. So that's 23% of mortgage holders. But remember, many homeowners in America don't have a mortgage. In fact, of the 97 million owner housing units in America, 37 million have no mortgage, or 38%. So that means that for those who have a sub 3% mortgage rate, it's 14% of all housing units. 14% have a sub 3% mortgage rate, which is a lot. It's good for some of you out there who have that low mortgage rate, but you can obviously see through the data that 14% of mortgage holders having a sub 3% mortgage rate is not what is keeping inventory off the housing market. There's another 85% of homes that have no mortgage or mortgage above 3% or that are vacant that could hit the market. And the reason they're not hitting the market is because the owners don't feel the stress to sell. That is the biggest reason why new listings and inventory are low. The unemployment rate's 3.6%. The US government has piled trillions and trillions of dollars into the economy over the last 3 years. They suppressed interest rates for a decade. They built an expectation that nothing bad will ever happen in the housing market again, and if it does, the government will be there to rescue it. That is why new listings are low. On top of that, there's also concern now about the banking sector in America. I just had one of you email me and say that they have their money in a small bank in Florida. They're looking to buy in Harrisburg, Pennsylvania, and they think that there will be a decline in value, but they actually would prefer to take the hit in value on real estate than leaving their cash in the bank. And so I wonder how many people would have sold their house this year, but didn't sell their house because they didn't want to get a windfall of cash that they would leave in the bank at a point in time when the banking sector in America looks perilous. I think that could potentially be an additional explanation for why inventory and new listings have been low this year. Ultimately, everyone, let's bring things from theory back to reality. What are, my projections for the housing market for the rest of the year, and what should you do as either a home buyer, investor, or realtor to ride out this storm? Well, if you're a home buyer, you have to understand that home prices are still tremendously overvalued, and that's not my opinion, that's a fact. In particular, the ratio of home price to income in America is near a record high today. It's 31% overvalued compared to its historical norms. The same thing for home prices to rent, and the same thing for home prices adjusted for inflation. What that means is that there's a very high likelihood that prices go down in the future because we've never been able to sustain these levels of prices in the US housing market before. Now, those declines might take more time to hit than some people expect. During the beginning of the last downturn in 2006, 2007, prices basically traded sideways for a year and a half before they really started to drop in the middle of 2008 when the economy started to tank. So what you have to do as a home buyer is decide what your risk tolerance is, how much cushion financially you have to absorb losses, and if frankly you can afford to buy a house right now at today's mortgage rates and prices. Now, if you're an investor, you just have to understand that this is a challenging environment to be an investor. Cap rates are still fairly low. Interest rates are high, meaning that the opportunity cost of capital says it's better to invest in a treasury than to buy real estate. However, if you do want to buy real estate, I would focus on higher yielding markets with more security, safety, and capital preservation qualities. I would not focus on boomtown markets where prices have gone up a lot over the last 3 years or where prices are very expensive. And if you're a realtor, you also just have to understand the realities of what the home sales figures are and how many realtors there are, and understand that realtors will continue to quit over the next year, which will be good for you if you're a realtor who holds out. You're going to have less competition, but it's very important now if you're a realtor to make sure that you differentiate yourself and add value to your clients. Particularly, can you unearth new listings and can you find would-be sellers on the housing market who have some maybe distress and want to sell but haven't gotten around to it yet? If I were a realtor, I would focus my attention more there than trying to get new buyer clients. Lastly, a big portion of my projections here on the housing market, everyone, have to do with the state of the macro economy. And my next video, I'm going to cover a very important topic, and that topic is the US government lying about the jobs figures in the economy? Because I've unearthed some very interesting data that suggests the economy is not nearly as strong as people think, which could have a big impact on the direction of home prices into the future. So if you want to see that video on if the US government is lying about the jobs in the economy, hit the subscribe button, turn your notifications on. It will be coming out soon.